how urgent is it for the Fed to make some direction on a March cut, or dare I even say a January first cut?
Well, it has a number of different dimensions. First, there is the dimension on the real economy. It's clear that the Fed pivot has eased financial conditions dramatically. And this begins to run the risk that we might see a repeat of what happened after Silicon Valley Bank. Remember, Chris Waller just said a few weeks ago, the easing of financial conditions in Q2, that boosted GDP growth to 5% in Q3. Could we see the same now, where the easing of financial conditions after the Fed pivot might actually be boosting the housing market, the labor market, services inflation, goods inflation? We are not out of the woods when it comes to battling inflation. So on the real economy, absolutely, the easing of financial conditions is very supportive. There are some issues when it comes to the plumbing, when the tightness, as you're highlighting, in very short-term markets, and the Fed for sure has to play this difficult tug of war between, do we want to ease financial conditions on the real side, or how much can we ease financial conditions in the very front end of the curve? But this is the challenge for the Fed at the moment that you're highlighting.
Torsten, you didn't listen. They didn't respond to the idea of financial conditions. They didn't seem to think it mattered at all at the last press conference. Why should it matter now? I mean, we're going to actually hear them come back and say, actually, just kidding, about that financial conditions question.
Well, they were debating in October and September, well, maybe financial conditions have done a lot of the work for us. And now they're saying, well, maybe financial conditions, it doesn't really matter because it can fluctuate so much. So I still think that it's a little bit inconsistent what they're saying. When the data dependency, it only talks about the real data, whereas the financial conditions impulse, if you take the easing in financial conditions that we have had since the Fed pivot and stuff it into FERPAS, the Fed's model of the US economy, you will get a boom of up to 1.5% growth over the next several quarters in GDP. It's going to be very supportive as a tailwind to the economic outlook.
Although we did have Gennady on earlier of TD Securities, and he said, even with this idea that inflation could remain stickier, that we could get this ongoing growth, the Fed could still cut rates and still be restrictive, given the positive real rate. Do you ascribe to that kind of thing, or do you think that this means many fewer rate cuts going forward for the Fed?
I think that's absolutely right. That we have, of course, for the better part of the last year, we have talked about higher for longer. Now the conversation is more restrictive for longer, because they can still be restrictive if inflation is coming down, because real interest rates is what matters. So if real interest rates are still positive as inflation comes down, the Fed can accordingly also gradually begin to lower rates. But note also that if you look at the outlook for SOFR futures, as also Tom was mentioning, you still have that the bottom will still be around 3.5–4%. So one very important conclusion for asset allocation is that we are not going back to zero. We have still higher for longer in the sense that the level of interest rates, the level of the risk-free rate on page 1 in your finance textbook will be significantly higher for the next several years than where it was from the period from 2008 to 2022.